Hey everybody, Steve here. Thank you so much for listening in. Thanks for the folks that came out tonight to grab their free gift. We're talking gifts of volatility. You also get a book if you are here in person, so please help yourself to that. I call it a good airplane book. There's nothing really like PhD level in here, but it is a kind of a good guide. Flip through it, read it if you get anything useful out of it. Give it to your kids, right, for their birthday present, and have them disown you as present as parents. But yeah, pay it forward if you like what it says. Tonight, we're going to talk about the gift of volatility. So you can think, what am I actually talking about? I'm talking about the roller coaster in the market. So you may think that that's a bad thing. I'm going to show you that it's a good thing. And then we're going to talk about the other things that are listed on this slide up here. Standard, kind of asking the question for the crowd, who loves volatility? Yep, not a lot of hands. You probably don't, but after this, you're going to be looking forward to periods of volatility. But if you're watching the video on replay, make sure you hit the thumbs up sign if you do like volatility there. Okay, standard disclaimer applies. This is me educating you on financial education stuff. Do your own diligence for acting upon anything you hear in here. We do talk about some individual stocks tonight and showing you their charts. We also are going to, if you need more disclaimer information, go to ankerstarwealth.com. All right, what is the gift of volatility? Let's talk definitions first. In a stock portfolio, it refers to the degree of variation of its value over time. So if you work with Ankerstar Wealth, you've heard me say things like you choose your roller coaster, right? So you go to the amusement park, go to Six Flags, and the 25-year-old version of you might have gone right to the biggest, baddest coaster out there and said, "Let's go," without much thought. The 55-year-old version of you might go, "Oh," make an excuse so you don't have to go on it with your kids, right? But you may not enjoy that as much. And it's the exact same experience. It's just your situation's different. So that's kind of the volatility that's in the market, is those up and downs. Under the remember there, they do move up and down the majority of the time. So every day on CNBC, if it goes up 1%, it's like this is like the most amazing thing in the world. And then when it goes down 1%, people are calling me and saying, "Steve, why is the market crashing?" Which I always kind of chuckle, because that just means they haven't seen a real crash. Because you would not be worried about it being down 1.5% on a Friday if you've lived through any of the volatility that we're going to talk about. The second bullet there, under remember, not all single stock drawdowns represent good opportunities. So when we're going to talk largely about the market, when the market sells off and has a heart attack, that generally is an opportunity. With individual stocks, it may be an opportunity, or it may be that they're headed to zero, which doesn't happen a lot, but it still can happen. And then last one is spinning volatility a little bit different. So volatility is a luxury. And okay, chuckles. Yep. Okay. Yeah. Well, it is. That's where you make your real money, is during these downturns, because it does allow you to buy shares cheaper. I like to say that the stock market is the only store you run from when things are on sale, right? Be 20% off, 30% off. It's like, nope, get out of here. Wait till it gets to all-time highs, and they're going to charge me more for the exact same thing. And you're like, yes, let's buy, that sort of thing. So we're going to talk about that. Okay, market volatility events. With this chart, if you can see it, has the dates of all the bear markets we've had since the Great Depression. So we're looking at, since 1929, almost 100 years of history. The big deal is this is the length of the bear market. So once the bear market starts, so think definitions. Once you're at 20% down, how many days after that do you regain that same level? Okay, it can be painful, but these are the periods of volatility that we're talking about. Most recent one in 2022, the Fed raised interest rates, and basically market started on the way down. We were down there for 282 days, which can seem like a long time when you're in the middle of it, but it really is, in the big picture of your investing lifetime, a blip, if you will. The stock crash, the internet crash of 2000, that was 929 days. Quick math, divide by 365. Yeah, that's like 3 years before you got back to even. Now, if you're not investing new money, yeah, that's a long time staring at your portfolio. But if you are investing, I'm going to show you that that was a gift that you just don't get very often. If you look at the COVID crash, which lasted 32 days from the time it hit the bear market till it completely recovered, 32 days, a lot of people don't check their stock portfolios in a 32-day period, right? That's literally a month. So, but if you were paying attention, they ran a 35% off sale during that time. So if you had money to invest and you weren't bled out and laying in the streets or talking to your therapist all day about the stock market selling off, then yes, that was a perfect time to buy, and hopefully you were able to take advantage of that particular situation. But the real theme here is this green one. On average, it's 340 days in a bear market. So if you enter a bear market, on average over the past 100 years, you're going to spend about a year there. It's no fun. Everybody likes waking up to new highs every day. But if you are regularly investing, which most of us do through our 401k in our workplace, and if you happen to be older than 50, congrats, you get to invest a little bit more on a monthly basis. But yeah, if you're putting money to work during that time, then you're going to be better off. And if you are not in a workplace situation where you have a 401k, something like that, then you can, via some of the instruments we have, like STRC, USFR, STRF, that JEPI, kick off a lot of cash. If you're not taking your cash out, we let that cash pool up. So anytime there's a dip, we can put that cash to work. And we'll show you the math behind it here in a second. Okay, the depth of the market. So the first one was time. How long are you in it? The second one is how bad can it get while you're in it? Well, you have the chart up here. I will verbalize it since it's a little hard to read for the folks at home. But basically, you have to be down 20% to be in a bear market. So that's where the chart starts. If you don't enter 20%, then it's all in the, not less than 20% sell off. But if you enter the 20% sell off, these are the same bear markets that were listed on the other slide. And this is how far it sells off. So, okay, there's one big bar across the top. We do have to talk about that. That was literally the Great Depression. 1929, the market sold off. People commonly say 90%, it's 83%. Not that there's a real difference on how much pain you're in if it sells off 83 versus 90, because you're in a lot of pain. But also think about when people sell, guess what happens when people sell during these sell-offs? Can they sell without anybody buying? No. There are exactly equal and always have been the same number of buyers and sellers in every trade transaction for the past 100 years. So therefore, be the buyer here, not the seller. The seller is the one that's selling things on sale. The buyer is the one buying things on sale. Easier said than done. If you have, and this is where it gets into how much of your exposure you want to private markets versus public markets will move and they will give you the gift of volatility. If you don't care for it, then reduce your exposure to public markets, enter the private markets. There's other options for you that don't move as much. Real estate does not do this, right? But it also doesn't give you that opportunity to enter at a pristine point. That's one data point. Most of them are in here. You look at the global financial crisis, 2007, 50 plus percent. That was during my lifetime the best opportunity for those that just either you sold and went to cash in there somewhere and you got back in low, or mostly like me, held through most of it and just took every little penny I could find and jam it in there while it was down, knowing I'm getting the sale of a century, right? So you get wealthy over the market going up, you get rich over the market going down. That does assume you have the investor's mindset and you're able to have capital to put to work at these times. So where's that capital come from? Generally, it's your income peeling a part of that to put into it. You don't necessarily need to sit with 250K in cash in the bank waiting for the next crash, because you might be waiting for the train that never comes. But certainly any new money, you want to take it and put it to work if you're in one of these dips. Okay, so mental framework. You want to think of this as, like I use the, pick your favorite vacation location, right? And I don't care who you are. I mean, it depends on your luck. But if you go there enough, storms are going to rip through your favorite vacation location while you're there. Same sort of thing with the market. The market is the number one by far wealth creation tool over time. It's the compilation of all the U.S. companies, and the weak get killed off, and the better just keep getting going higher. But that doesn't mean storms don't rage through. So just like your beautiful place, whether it's Cancun or the Maldives, it's gonna rain and storm and be miserable during those times. So expect that. So the planning ahead is the mental framework is, yes, there will be a day you wake up and the market's going to sell off 5% that day. It's going to happen. So when it happens, you're better mentally adjusted for that happening. It's a normal part of the market. You don't want things to go straight up forever, hence the internet bubble, because then they come crashing down hard. And the math matters, and that's where we're going to take math that we all know and put that in our corner. You can see the holding hand there, if you're familiar with the crypto term, diamond hands. This was Corey's kind of very very basic attempt at showing that diamond hand scenario with a little Bitcoin in there, because it does it does follow the same sort of thing. We'll talk about Bitcoin here in a minute. So with that expectation of a market crash, so most everybody in the room is a lifelong investor, except for maybe starting starting out. However, if you invest for a 15-year period, historically there's a 100% chance you're going to have a bear market. So that means if you commit yourself to lifelong investing because you want the wealth creation from it, you're gonna have this. It's coming. We don't know when. It's obviously not predictable, but when it happens, you need to not freak out and just think about, okay, this is all the natural ebb and flow. Let's put some money to work, or the most we can, if you will. So those are your odds of experiencing. And then when you're in it, it's tough, right? It's you know, kind of like in combat a little bit. If you when things are at their worst, that's when you need to be your calmest, because that this too shall pass, right? So no matter how bad the market gets, it's coming back. It's undefeated, right? Could there be a time people are like, well, I suppose, but there's a lot bigger problems if that's the case. But it's undefeated the way it's designed. And how can it go up forever? Because the weak are killed off and the strong get stronger. That's generally doesn't exist in too many places, but in a capitalist society, this is exactly where it happens. That's why it continues. But take a close look at this chart. The reason I titled it "The Market Doesn't Wait," or Ritzholtz, who gets credit for this slide, is when you're in it, it sucks. Every time you look at your app or checking it out, or you're just seeing red, and you're seeing bigger red numbers than I mean, all red numbers are kind of bad, but big red numbers really bad, right? It can affect you at work. It can affect your relationships. It can affect you personally. You might get depressed during this time. Those are all very natural reactions. So therefore, we want to talk about it. It is going to happen. So that way you're a little better adjusted when it happens. You simply go, okay, this is bad, and what are we going to do about it? So you separate out the emotion the best you can. We're all humans, and you really focus on the facts. But what the gift that you're getting here is that for anything you can acquire, yes, so you have 900,000 that's taking a huge hit, but if you got 20,000 to put to work, that's where you jam it in to take advantage of it. And when it's at its worst, then the low will appear. So the if you wait for a signal, and I get this all the time, it's like I just want to wait. I want to wait for the all clear signal, right? Well, the battle's over by the time the all clear, from a combat thing, is the battle's over when there's an all clear, right? You got to fight every second, and even in the worst, it's a fight to the death, right? To make sure that you get out to the other side. There is no waiting for the all clear, right? So same thing in the markets. The low of 2000, this was the COVID low. If you're waiting for the earnings per share to adjust, you would have waited 13 months. 13 months past the actual bottom of the market. So insane how much the market reacts first. Now, the market is anticipating the anticipations of others. So to process that, you don't want to just anticipate what's going to happen. The best of the best anticipate other people anticipating what's going to happen. So markets don't stay depressed that long. They come raging back. So 13 months between the S&P bottom and the actual earnings getting better. And then if you wait on GDP, a lot of people use that, right? That's the recession indicator, 2 periods of negative GDP, which often causes that bear market. If you wait for the GDP to recover, then again, you're looking at 3 months afterwards. So if you're on the sidelines during that 3 months, you simply have to resume the chart here. That's when you're willing to buy again. So you're not buying here because you're kind of freaking out. And then you have to wait for it to recover so you don't buy there. And basically that whole sale is now behind you. So that's when you want to have your moment of clarity, win everything when there's blood in the streets, to try to be able to put some stuff to work during that time. Okay, little math for you, if you will. So as if you can see this chart, just take a look at the, kind of the data points. This is an investor that has 3 different scenarios, invest $240 a month. And this is their journey, right? And this is over a I think it's a 3-year period or 12-month period. How does volatility benefit or inhibit the investor's experience, if you will? Well, when you look at the top one, most people would like, Steve, give me that chart, right? I don't ever have to sweat about being down money. It goes up and it stabilizes and up and stabilizes and just kind of takes a stair step higher. Who doesn't want that? And I'm like, well, you know what? You may like that, right? The only things that really do that are like fixed income instruments that really don't go down, but they go up. So anyhow, at the end of that, with 240, the same amount goes into all these 62 shares at $60 a share is what their current math is. This one spiked from $20 up to 40. It doubled, so everybody's happy. And then it started selling off and went back down to 20. Then it dropped down to 10. And then it started its march, and it is only recovered only about halfway to its high. Same thing, $240 are going into the engine. Each time you end up with 142 shares, but at $30, right? Half of what the top one is. And then the second one is you're at $20, it starts to dip, and then it kind of goes all the way back and ends up where at that $20 again. So how does that work out math wise? Same amounts, the top and the bottom are the same. They have the exact same amount of money at the end of the day. These shares got more expensive, so they have less of them. These shares went on sale, so they pick them up while they're cheap. Same amount of money for the same investor, 240 in for 12 months, and they have the same amount. The best path, if you're looking to make the most money, i.e., purpose of investing, this is the path you want. So you don't care that it spiked up. You're happy that it went down. So the whole time you're loading up, getting more and more shares, you end up with more shares. Even at a middling price is going to give you more money. And these two are all the way back at their highs. This is not even near its high again. So by the time it gets to the high, you're going to have a lot more money. So just think about that. You don't want a straight line up. You don't really even want to stair step up. It's okay if it whips around, especially if you're putting new money to work on a regular basis, i.e., the 401k type model, or you have $1,000 a month coming in from the bank account, stuff like that. Okay, let's talk about a few names. This is not an endorsement of these names, albeit this one's pretty good. Just saying. Netflix, this is a 7-year chart. So this is from late 2018 all the way through to current day, basically within a week of current day. The left is the stock price. The right two charts, we have revenue up top and margins down at the bottom. Revenue, you don't even need to know the denominator except for revenue is increasing, which means the company is growing over a 7-year period on pretty much it's as close to a straight line as you're going to get as far as revenue. Margins, the margins down here are around 11% and then up at 29%. So even when the margins went down during this period of 22 to 20 to 23, that was the interest rate raise, right? Margins dropped 5%. That was so bad in the news cycle that the stock sold off 73%, right? So let's talk about this. Maybe you love Netflix and you're just waiting for some entry, right? Maybe you hear that the Fed's going to raise rates and you're like, Steve said, market's going to sell off here, so let's wait on buying Netflix. And then it starts to go down. Now, I'm under no illusion, and there's nobody out there that can just wait for it to drop to the exact low and then buy and then move back up. That doesn't happen, and that's not the point of this chart. The point is, though, that if it starts moving down and you get 30% off of the highs, that's a pretty good time to start picking up some shares. If you're in this period of sell-off for a while, 2, 3, 6 months, 12 months, then you can keep adding to the stocks that are your favorite during that time. So you won't get exactly 73% of the sale, but everything's going to average out to like a 50% sale, all because of a little bit of hit to margins that nobody really cares about, except for the headline is, Netflix misses earnings, for the first time in, some crazy sensationalized headline on CNBC, and people sell in masses. Also happens to Meta, which is Facebook. 76% sell off, roughly the same time period. Their margins went down 12%. Even at the lowest, this is a 28% margin. I don't know what business you run. 28% margins, all right. That's like their worst performance was the 28%. So, and now they're back up to 44%. So basically a 12% peak to trough drop led to a 76% drop in the stock. So we talk thesis and conviction around here. We don't really, not going to get into that today. But if you like a company, you have a thesis for why you own it, and you want to buy more of it, then you should take advantage of sales. If the thesis changes, that's when you need to sell. Otherwise, you're a net buyer, if you will. Google, same thing, a lot stronger. Let's see, a lot stronger and a lot flatter revenue base, if you will. You see the revenues are just going straight up. Margins, yep, get a little hiccup, 5%. Who cares? I mean, literally, that's still a 25% margin, caused the 41% sell off in the stock. So this is the emotion selling off and retail investors selling off, and then the professionals buy in here. So something to consider. Bitcoin, if you are a fan of Bitcoin, there's times when it screens higher and sets new highs, which was not that long ago, and then it crashes Okay, I don't buy that it crashes 10, 15%, but it does move, right? So if you're at like, you should really never think that you have missed the train on Bitcoin because it is good to you and it always gives you another entry. Now, someday that won't be true, but it's historically sold off significantly at certain times. During the sell-offs, nobody wants it, right? During when it hits new highs, everybody's got to have some more. That's backwards. Don't let that be you. So how can you use this as a predictive thing? I told our team, pick a stock that we're not invested in. So that way we don't have a pre-biased opinion. So we found Adobe. It's a software company that you've heard of. So as a professional investor, we benefit from there's lots of cash. And I look today, we have 7 million in cash. And I hate cash. I'm always trying to put cash to work. We still have 7 million of it in a $150 million book because cash is constantly flowing in through dividends, new money, etc. So every day we're looking for these deals, which is generally, if it's the market, then you're putting it all to work. If it's individual stocks, you're looking for entry points. I'm not saying Adobe's a good entry point here. I'm just saying when you look at the charts, the revenue and the margins on the right are very similar to what you saw out of the other firms. And you've got a stock that's basically most recently sold off 51%. Does that mean it's going higher? No. But this is the kind of chart when you start to look at it. And if I were to channel my inner Corey here for a second, at great risk of doing a terrible impression, he would find this chart very juicy, Steve. So that's what he's looking for, especially when he's looking for these value entries. So he's the pro at this. So something to consider. At least that's how we use it here. Okay, last I'll close with this. Plan ahead. Know that the volatility is coming. It's gonna hurt while you're in it. But if you have your plan going in of like, I know exactly how I'm going to handle this, then you've got you've got it, and it does give you the opportunity to put math on your side. So you say, what if I don't have a 401k? I'm either in retirement or I'm in self-employed. Then it's we are, if you're with us, again, we don't reinvest the dividends automatically. We let the cash pile up. So literally every day there's a huge chunk of like 100K coming in through dividends and stuff. So we've got your back in the fact that we're doing that in your account, whether you notice or not. And then if you're self-employed, there are options for you to set up on a monthly sort of thing to put money into your accounts. So put the math in your corner. All right, that's who we are. Thank you so much for attending. And are there any questions before we close out? Didn't seed you with questions this time. All right, no questions here. All right, thanks everybody for listening. Again, if you are local and you want your gift, not just the gift of education, you're welcome, but your actual gift of this book, then just let us know. You can either swing by and get it, or next time your advisor meets you in person, you can have a copy. So thank you so much for listening in, and we'll talk to you next time.